Let me ask you something. What if one law could change your taxes, impact your children's future, and determine how much money stays in your pocket for the next decade? Imagine that. Well, that law just passed. You know, life has a funny way of testing our balance. I mean, one day you're making progress, and the next, boom, a new law changes everything about your money, your taxes, even your healthcare. So, what's this one big, beautiful bill everybody's talking about? On July 4th, 2025 this year, President Trump signed what's being called the One Big Beautiful Bill Act, aka OBBBA. Some are calling it patriotic, others are calling it political. But what I care much about and what you need to know is, how will this bill affect your money and my money, our legacy, and our peace of mind? I'm Coach Lola Owokoniran, and on this channel, we make financial truths really simple and strategic and spiritual as well. I help people like you build wealth, leave a legacy, and live with purpose from the inside out. If you're new here, welcome, welcome, welcome. And be sure to like, share, and subscribe so you never miss any of our episodes every week that could really change your financial future. Whether you live in Atlanta, Accra, Lagos, Toronto, London, Paris, what just happened in the US is not just an American issue. Why? Because the US economy has a ripple effect. If you work remotely, send money overseas, pay tuition, run a business, or even manage your parents' healthcare, you are already in the ripple. You are very much affected here. You've probably heard President Trump did sign his One Big Beautiful Bill on July 4th, Independence Day, with parades, jets flying, overhead helicopters, cameras flashing and all. But truly behind the celebration, here are real financial consequences for the everyday people. Nearly 12 million people could lose Medicaid coverage. Student loan repayment rules are shifting again. And if you own a small business or work for tips, your taxes might look very much different this next year. But don't worry, I'm going to break it all down to you in plain English. No politics, no panic, just the simple truth. And what you truly need to know and truly need to do right now to stay in control of your money and your future. A few years ago, I was working with a single mom of two. Let's call her Chanel. Chanel was doing everything right, from budgeting to saving and paying off her debt. Then one law changed and bam, her Medicaid eligibility was gone, just like that. Her food benefits were cut and her student loan payments doubled. All that effort wiped out by a few lines of legislation, the law. That's why this episode matters. Because whether you live in the US, Canada, Ghana, the UK, Asia, or anywhere in between, what happens in the US economy often has a ripple effect globally. And financial laws don't just hit your paycheck and my paycheck, they hit our peace of mind. On July 4th, Trump signed a new tax law that makes 2017 tax cuts very much permanent. It introduces new deductions for seniors, parents and workers as well. It cuts funding in other areas like Medicaid and clean energy to pay for it. In short, it's the biggest tax shift since 2017. And the goal was to avoid tax increases set to happen in December of 2025. So here's what's actually in Trump's big, beautiful bill, officially called One Big Beautiful Bill Act, OBBBA. It's a $4 trillion spending bill, and here's how it actually affects your money and my money. Let's start with taxes. Tax cuts continue, but not for everyone, I know. The bill makes the Trump-era 2017 tax cuts very much permanent, especially now for corporations and high-income households. The 7 tax brackets stay with a top rate of 37% and a bottom rate of 10%. Standard deduction increases to $15,750 for single and $31,500 for married couples, and will now be permanently indexed to inflation. There's also a $6,000 extra standard deduction for seniors over 65 years of age. This phases out after $75,000 for single or $150,000 for married. To all seniors, make sure to plan well because this could help offset your Social Security taxes for many retirees. There's now a bigger child tax credit if you're married and earn under $500,000. The child tax credit increases to $2,200 per child, up from the Tax Cuts and Jobs Act of $2,000. The personal deduction of $4,050 per person pre-2017 is now permanently gone. It no longer exists. Before 2017, you could deduct about $4,050 per person on your tax return for yourself, your spouse, and for each child. That's all gone now, permanently. The government's way of balancing that out is with a larger standard deduction and an expanded child tax credit. They increased it. This means you need to rely on standard deductions plus tax credits to balance your taxable income and pre-tax savings tools. Also, the gift and estate tax exemption goes up to $15 million per person or $30 million for couples. Middle income earners will see modest relief here, but the biggest benefits go to the top 10% of the wealthy population. Mortgage interest remain deductible up to $750,000 in debts. And now, if you're in the service industry, there's good news. The bill includes a $25,000 tax-free threshold on tips and overtime pay. This is a win for waiters, barbers, nail techs. Anyone hustling for extra income, this is for you. For anyone working in this industry, track every extra dollar that you earn. Tips, your gigs, your bonuses, keep your receipts, and get your deductions, people. But here's the truth. High income earners and corporations will benefit the most from this bill. These changes help also to reduce taxable income and will help preserve more wealth for families, especially those earning middle to high incomes. In my opinion, these changes are big wins for tax planning, especially for those building generational wealth. Be mindful here, these perks phase out quickly if you earn more or you live in a high tax state where the SALT cap was raised to $40,000, but only if you make under $500,000 and just for a window of time. After 2030, we go back to the $10,000 cap permanently, sadly. Let me take a minute here to explain the SALT deduction cap. SALT, spelled as S-A-L-T, like your spice. SALT stands for state and local taxes. When you file your federal tax return, the IRS allows you to deduct certain state and local taxes you've already paid on things like property taxes, state income taxes, or sales taxes, city or county taxes. Now, this deduction helps prevent double taxation where you would have been taxed twice on the same income, once by your state or your local government and again by the federal government. In 2017, Trump's Tax Cuts and Jobs Act placed a limit, or I would say a cap, on how much SALT you and I can deduct. And it was $10,000 per year maximum, or $5,000 if you're married, filing separately. That means if you paid, assuming $20,000 in state and property taxes in a high-cost state like New York, California, New Jersey, Illinois, and so on, you could still only deduct $10,000. That's some relief there. Now, this cap has hurt homeowners in high tax states. It has increased tax burdens on middle to upper middle class earners, created pressure in states with expensive real estate. The pressure is real, and high income taxes. On the updated big beautiful bill passed on July 3rd, signed on July 4th of this year, Trump's new bill raises the SALT cap now to $40,000, but only for households earning under $500,000 per year. That simply means more taxpayers in states like New York, New Jersey, California, and even Georgia could deduct more of their local taxes again. But wealthier earners still face the original $10,000 cap. And if you earn your money abroad or through remittances, there's now a 1% remittance tax on funds that you send outside the US. Simple translation, if you live in these states like California, New York, New Jersey, this is a temporary win. Plan your home purchases and deductions strategically over the next 5 years. So while this act lasts, make sure you make strategic moves towards your real estate. So while this sounds very beautiful for some of us, the beauty may not extend to everyone, especially if you're low income, living in a high tax area, or sending money to your loved ones abroad, overseas. One tip on the SALT deduction is to plan real estate purchases on property tax payments strategically over the next 5 years. Next up, healthcare. This is where it gets serious. The bill proposes $1 trillion in cuts to Medicare and Medicare over 10 years. Now that's a 12% reduction. Real people will feel that. An estimated 11 to 12 million Americans could lose Medicaid coverage under new work requirements. That means if you're not working a minimum number of hours, you may lose your health benefits, even if you're dealing with chronic illness, caregiving, or mental health challenges. This is going to impact a lot of Americans. Seniors, veterans, and low-income families will have fewer benefits and rural hospitals, especially in the southern states. These states may lose funding. Medicare's provider reimbursements are also shrinking. That could mean fewer doctors accepting Medicare, longer wait times, and reduced care quality for older adults. If you're a caregiver approaching retirement or managing long-term illness in your family, this is the time to review your coverage and prepare, please, for potential costs that might come out of pocket. Or try to see what health benefits, what health tips you can start practicing. Let's talk about food assistance. The SNAP and food aid is shrinking because this will also hit working class families and immigrants the hardest. SNAP is also known as food stamps, SNAP. Food stamps now have stricter work requirements for adults without dependents. If you're between the ages of 18 and 55, you have to prove you're working or in job training for at least 30 hours a week to keep your benefits. Previously, the cutoff was age 49 and the hours were lower. These changes are expected to reduce food stamp SNAP enrollment by millions, especially in communities already struggling with food insecurity. States will have to pick up more administrative costs. That means delays, paperwork hurdles, and tighter state budgets, especially in low-income or high migrant regions. And let's not forget, undocumented immigrants are now completely excluded from all federal benefits. No SNAPs, no food stamps, no tax credits, no ACA subsidies, all gone permanently. If your household relies on food benefits, now is the time to create a backup plan. Build a food budget and explore local food banks or nonprofits in your area, or start farming. Look into agriculture. Start small and gradually increase your farm. Next up, let's talk about student loans. Student loan shakeups. This one hits home for students, young professionals, and even parents. Yes, parents saving for college. This affects you. The new law caps how much graduates and professional students can now borrow federally. That includes all our future doctors, our lawyers, therapists, and engineers, many of whom rely on federal aid here. Law and math students will now be limited to about $200,000 in total in federal loans. I know. Grad students in other fields will be capped closer to $100,000. Borrowers may now be expected to pay 10% of their discretionary income with limited forgiveness options. So, what would you do? Here's my recommendation. Parents, update your college savings strategy. If you don't have one, reach out to a financial professional like myself. Students, research into scholarships, state-based grants, and explore community college transfers. And to our borrowers, talk to a financial coach like myself before refinancing or consolidating. Now, let's look into our business owners. What does President Trump have in stock for them? If you're self-employed or a small business owner, this is where you want to pay much attention. The bill keeps some pass-through tax deductions, which means S Corps and LLCs can still deduct up to 20% of qualified income. It simplifies certain bookkeeping requirements and expands bonus depreciation. So if you buy equipment or software in 2025, you can write off much more upfront. But clean energy incentives are being phased out. So if your business is in solar, EVs, green tech, or sustainability, you will see reduced credits and limited support here. There's also a crackdown on freelancers and gig economy loopholes here. So if you use apps like Uber, DoorDash, or Upwork, you are very much likely going to see tighter reporting rules, fewer write-offs in this category. But here's what I recommend. Work with a tax professional or reach out to us here at Immigrant to help with your bookkeeping and your accounting with our Smart Books consultation for your monthly bookkeeping and tax optimization. Review your business structure. Consider LLC versus S Corp. Start preparing your 2025 Q4 now. Please don't wait till December. Deduct car loan interest on US-made vehicles. Yes, you heard me. This is a new one. You can now deduct up to $10,000 in interest from a car loan. As long as the car was assembled here in the US, it qualifies. Income limits are set at $100,000 for single or $200,000 if you're married. If you're planning to buy a car, here's a tip for you. Check the VIN number to confirm the US assembly and consider financing instead of paying cash. I'm just saying, just to use this deduction smartly. Check it out. Number 8, introducing Trump accounts for kids is included on this one big, beautiful bill. Think of this like an IRA for children. Starting in 2025, parents and relatives can now contribute up to $5,000 per year into what we call a Trump account. Now, this is new, and that turns into a traditional IRA when that child turns 18. A bonus here, if your child or your baby is born between 2025 and 2028, you get $1,000 of federal seed money. If you want to bless your children with a head start, this right here is your legacy play. Take advantage of it. Number nine, expanded use of HSAs and 529s. Now, your HSA can cover $150 per month for direct primary care and telehealth permanently now. Your 529 education plan can now pay for standardized tests. Yes, you heard me. Outside tutoring. Yes, you heard me. Therapy for kids with disabilities and career certifications beyond college. This is a game changer for many parents out there. These changes help families with non-traditional learners, homeschoolers, or students with learning differences to thrive. And finally, what about the rest of the world? Because we truly know that what happens in America does not stay in America. The bill's high military spending and economic shifts are strengthening the US dollar. But that can also drive up interest rates globally, affecting emerging markets and increasing borrowing costs in Africa, Asia, and even the Caribbean. In other words, a stronger US dollar from defense spending may affect global interest rates, inflation, commodity prices. US remittances, money sent to family overseas from one part of the world to the other, are now taxed 1%. That means less money going to help our families, siblings, or even children abroad. And that tax hits working class immigrants the hardest. From a faith-based perspective, we are called to be wise stewards. No matter what policy changes come our way, that means trusting God for provision, adjusting your strategy when the economy shifts, advocating for the vulnerable and undeserved, and continuing to build wealth with clarity, purpose, and peace. This bill may change laws, but it doesn't change God's promise for your legacy. So, what do we do when things shift like this? Here's what I tell my clients and community. Don't panic. Prepare. Download my free financial reset workbook. Talk with a tax professional this quarter, today, this month. Review your tax situation, especially if you are self-employed or work hourly. Please don't wait until next year. Start a Trump account or 529 for your child, for your grandchild. Audit your income sources, tips, gig works, overtime. Audit it, document it. If you're over 65, maximize both senior deductions. Everyone, review your estate plan if you benefit from the new gift tax exclusions. Update your health coverage plan and know your rights. Start or rebuild your emergency fund if you are impacted by Medicaid, Medicare, or SNAP, the food stamp changes. If you are a student or a parent, reevaluate your college funding strategy today. And no matter what, keep building wealth on purpose. Your legacy does not stop because the law changes, but your strategy should change. If this video helped you understand what's going on, please do me a favor. Like it so others can find it, so more people can learn and be prepared. Share it with a family member, a friend, a coworker. Share it with someone trying to get their money right. It might just save them from a big financial surprise. And subscribe for our weekly videos where we break down money matters in a way that makes sense. Subscribe right here to stay ahead, to stay informed, and stay empowered. This is Coach Lola reminding you, no matter what the world throws your way, you can still build wealth, leave a legacy, and live with purpose. You don't need perfect conditions to build a powerful legacy. So, start where you are today. Prepare with wisdom. Live with purpose. Let's stay informed. Let's stay empowered. And let's build, grow, and thrive together. See you in the next video. Bye for now.